Something strange is happening in the portfolios of two of the world's most successful investors. Warren Buffett, the man who avoided technology stocks for most of his career, just sold over $50 billion worth of his biggest tech position. At the same time, Bill Ackman, who has historically focused on old economy businesses, is loading up on tech giants like he has never done before. These two billionaires are making completely opposite bets on technology heading into 2026. One of them is going to be spectacularly right. The other is going to be wrong. And if you understand why they are taking such different positions, you might be able to figure out which side of this trade you want to be on. Let me start with the move that shocked Wall Street. In the first half of 2024, Berkshire Hathaway sold approximately $50 billion worth of Apple stock. $50 billion. That is not a trim. That is not taking profits on the edges. That is cutting the position nearly in half. Apple had been Buffett's largest holding by far, representing nearly 50% of Berkshire's entire stock portfolio at its peak. He had called it probably the best business in the world. He had said he loved it even more than some of the businesses Berkshire owns outright. And then he sold half of it. The official explanation was taxes. Buffett mentioned that capital gains tax rates might rise, so it made sense to realize gains now. But here is the thing about Warren Buffett. He has spent his entire career telling investors to ignore taxes when making investment decisions. He has held positions for decades specifically to defer taxes. He famously said his favorite holding period is forever. So when Warren Buffett suddenly becomes concerned about taxes, something else is going on. Look at the broader picture. Berkshire did not just sell Apple. They sold Bank of America. They trimmed other positions, and they let cash pile up to record levels. Over $325 billion sitting in treasury bills. That is not the behavior of someone who thinks stocks are attractively priced. That is the behavior of someone who sees risk everywhere and is waiting for better opportunities. Now contrast this with what Bill Ackman has been doing. Pershing Square has been aggressively buying technology stocks. Ackman built a massive position in Alphabet, Google's parent company. He bought into the AI narrative. He has been vocal about his bullishness on tech platforms and their ability to monetize artificial intelligence. While Buffett retreats from tech, Ackman is charging in. This creates a fascinating situation. Two of the smartest investors alive, both with decades of outperformance, both with access to the same information, are reaching completely opposite conclusions about technology stocks. How is this possible? And more importantly, who is right? To understand this divergence, you need to understand how each investor thinks about technology. Let me start with Buffett because his evolution on tech is one of the most interesting stories in investing history. For most of his career, Buffett completely avoided technology stocks. He famously passed on Microsoft even though Bill Gates was a close friend. He watched Amazon go from a bookstore to one of the most valuable companies on earth without buying a single share. He missed Google, Facebook, Netflix, the entire first wave of the internet revolution. His reasoning was simple. He did not understand these businesses well enough to predict where they would be in 10 or 20 years. Technology changes too fast. Today's winner becomes tomorrow's loser. The moats that protect tech companies are constantly under assault from new innovations. Remember, Buffett built his fortune on stable businesses with predictable cash flows. Coca-Cola, Geico, See's Candies. Businesses that looked essentially the same decade after decade. Technology was the opposite of everything he looked for. Then something changed. In 2016, Berkshire started buying Apple. At first, it was a relatively small position, but Buffett kept adding. By 2018, Apple was Berkshire's largest holding. Buffett explained that he had changed his view. Apple was not really a technology company anymore. It was a consumer products company with an incredibly loyal customer base. The iPhone was like a razor with a very long blade. Once you were in the Apple ecosystem, you stayed there. The switching costs were enormous. The brand loyalty was unprecedented. This reframing allowed Buffett to fit Apple into his traditional framework. He was not buying a tech company. He was buying a consumer franchise with a moat built on ecosystem lock. In and for several years, this thesis worked brilliantly. Apple's stock soared. Berkshire made over $100 billion on the investment. It seemed like Buffett had finally cracked the code on technology. But now he is selling. Why? Here is what I think is really happening. Buffett is looking at Apple and seeing a business that might be approaching the limits of its growth. iPhone sales have plateaued. The services business is growing but facing regulatory pressure. The China market is challenging due to nationalism and competition from Huawei. And the next big thing, artificial intelligence, is not obviously Apple's strength. More broadly, Buffett is looking at technology valuations and seeing bubble territory. The AI hype has pushed stocks to extreme multiples. Companies are valued not on what they earn today, but on optimistic projections about what they might earn in some AI-dominated future. Buffett has seen this movie before. He watched the dot-com bubble inflate and pop. He saw great companies become vastly overvalued and then crash 70, 80, 90%. He knows that even wonderful businesses can be terrible investments if you pay too much. The cash hoard at Berkshire tells us that Buffett cannot find much to buy at current prices. Technology is expensive. Banks are dealing with commercial real estate issues. Consumer companies face margin pressure. Energy is cyclical. Where do you put $300 billion to work when everything looks pricey? You wait. You collect your 4.5% on treasury bills, and you keep your powder dry for when the real opportunities emerge. Now, let me explain Bill Ackman's opposite view, because it is equally rational given his framework. Ackman looks at technology, particularly the big platforms, and sees something different than Buffett. He sees businesses with enormous competitive advantages that are actually getting stronger, not weaker. He sees the AI revolution as an opportunity, not a threat for the established giants. Consider Alphabet, Ackman's largest technology position. Google has a monopoly on search that has proven nearly impossible to disrupt. They have YouTube, the dominant video platform. They have Android, the operating system running on most smartphones globally. They have Google Cloud, growing rapidly in enterprise services, and they have DeepMind, arguably the most advanced AI research lab in the world. Ackman's thesis is that AI will not disrupt Google. It will supercharge Google. All of that data from search, from YouTube, from Android, from Gmail, from Maps, becomes the fuel that powers AI systems. Google has more data and more compute power than almost anyone. In an AI world, that is an enormous advantage. Furthermore, Ackman points out that Alphabet is actually cheap relative to its earning power. Strip out the money, losing moonshot projects, value YouTube and cloud separately, and the core search business is trading at a very reasonable multiple. You are essentially getting the AI optionality for free. This is a classic Ackman analysis. Sum of the parts valuation, identification of hidden assets, a thesis about how the market is mispricing the opportunity. Ackman is also more comfortable with technology because he has studied these businesses deeply. Unlike Buffett, who admits he does not fully understand tech, Ackman has spent years analyzing how these platforms work, how they monetize attention, how network effects create sustainable advantages. He believes he has the expertise to identify which tech companies will win and which will lose. There is another factor at play. Time horizon. Buffett is 94 years old. He is thinking about Berkshire's next 50 years, not the next 5 years. He is positioning the company for whoever comes after him. That means emphasizing stability, predictability, and resilience. It means avoiding situations where being wrong could cause catastrophic losses. Ackman is in his 50s. He has decades more to run money. He can afford to take more risk, make bigger bets, and ride out volatility. If AI takes longer to materialize than expected, he has time to wait. If one of his tech positions drops 50%, he can hold through the drawdown and wait for recovery. His time horizon allows for a more aggressive approach. Let me dig into the specific arguments each side is making about technology heading into 2026. The bulls, led by investors like Ackman, make several compelling points. First, they argue that the big tech platforms have proven remarkably durable. Google, Microsoft, Amazon, Apple, Meta. These companies have been dominant for over a decade. Despite constant predictions of disruption, despite regulatory threats, despite new competitors, they just keep getting stronger. Their advantages compound over time. Network effects, data advantages, and ecosystem lock create moats that are nearly impossible to cross. Second, the bulls argue that AI is a massive tailwind, not a threat. For these companies, training AI models requires enormous amounts of data and compute power. Who has the most data? The platforms. Who has the most compute? The hyperscalers. Who can afford to spend billions on AI research and development? Only the giants. Smaller competitors simply cannot keep up. AI is widening the moat, not narrowing it. Third, the bulls point out that valuations, while not cheap, are reasonable for businesses of this quality. Microsoft trades at around 30 times earnings. Alphabet trades at around 20 times earnings. These are not crazy multiples for companies growing revenue double digits with high margins and massive competitive advantages. Compare them to the dot-com bubble when companies traded at hundreds of times revenue, not earnings. Revenue, we are nowhere near that kind of excess. Fourth, the bulls argue that the AI productivity revolution will benefit the entire economy, but technology companies will capture a disproportionate share of that value. If AI increases economic output by trillions of dollars over the next decade, the companies providing the AI infrastructure, the platforms, the cloud services, the software will be the primary beneficiaries. This is a generational opportunity. Now let me present the bear case, the perspective that seems to be driving Buffett's caution. The bears make equally compelling arguments. First, they argue that technology valuations already reflect extremely optimistic assumptions. The market is pricing in massive AI benefits that may take much longer to materialize than expected. History shows that transformative technologies often take decades to reach full productivity impact. The Internet was invented in the 1960s. It did not really transform productivity until the 2000s. AI might follow a similar path. If the benefits are delayed, current valuations make no sense. Second, the bears point to competitive dynamics that the bulls are ignoring. Yes, the giants are dominant today, but technology creates new attack surfaces constantly. What if AI allows new entrants to compete effectively against Google in search? What if open-source AI models commoditize what the platforms are selling? What if China develops competitive AI that fragments the global market? The bulls assume current advantages persist. History suggests disruption always comes eventually. Third, the bears highlight regulatory risk. Governments around the world are scrutinizing big tech like never before. the Department of Justice is pursuing antitrust cases against Google and Apple. The European Union is imposing massive fines and restrictions. There is bipartisan agreement in Congress that something must be done about big tech power. These regulatory threats could materially impair the business models that investors are paying premium multiples for. Fourth, the bears point out that capital discipline has collapsed in the AI arms race. Tech companies are spending tens of billions of dollars on AI infrastructure with no clear path to returns. Microsoft is spending $50 billion annually on capital expenditures. Google is close behind. This spending might pay off magnificently, or it might turn out to be the biggest capital destruction in corporate history. Remember when telecom companies spent hundreds of billions building fiber networks in the late 1990s? Most of that investment generated terrible returns. AI capex could follow the same path. Fifth, and this is crucial, the bears argue that the trade is incredibly crowded. Everyone owns tech. The biggest institutional investors have massive positions. Retail investors have piled in through ETFs and direct ownership. When a trade gets this crowded, the downside when sentiment shifts can be severe. There is no one left to buy, but plenty of people who might want to sell. Let me talk about what the data actually shows about these competing views. Start with valuation. The technology sector is trading at about 28 times forward earnings, compared to a historical average of around 20. That is expensive but not extreme. Strip out the magnificent 7 megacaps and the rest of tech is actually trading below historical averages. So the valuation concern is really concentrated in a handful of names. Look at earnings growth. The big tech companies are actually delivering. Microsoft grew earnings over 20% last year. Alphabet grew earnings over 30%. Meta grew earnings over 60%. These are not hope and hype valuations. These are valuations based on real, tangible profit growth. The question is whether that growth can continue. Look at cash generation. Apple generates over $100 billion in free cash flow annually. Microsoft is close behind. Alphabet, Meta, all throwing off massive amounts of cash. These are not speculative money losers hoping to eventually turn profitable. These are cash machines with fortress balance sheets. But also look at the marginal investments. AI capital spending is exploding with questionable returns so far. The hyperscalers are building data centers at a breakneck pace. But the revenue from AI services is not yet covering the cost. At some point, that math needs to work. If it does not, we will see write-downs and retrenchments that could pressure stocks significantly. Here is my assessment of who is likely to be right. And I want to be honest. I do not think there is a clear answer. Both Buffett and Ackman are making rational decisions based on their frameworks, their time horizons, and their risk tolerances. Buffett is probably right that valuations are stretched, and that the risk-reward on technology has deteriorated. When the greatest investor of all time is holding record cash rather than buying, that should make you cautious. He has seen enough market cycles to recognize when prices are detached from fundamentals. But Ackman might be right that the specific companies he is buying have sustainable advantages that justify current valuations. Not all tech is created equal. There is a difference between a speculative AI startup and Alphabet or Microsoft. The dominant platforms have real moats, real earnings, and real growth prospects. The most likely outcome is that both are partially right. Technology will probably not crash 70% like in the dot-com bust because the current leaders actually make money. But it also probably will not continue producing the kind of returns seen over the past decade because much of the good news is already priced in. We might be entering a period of more modest returns, occasional corrections, and greater selectivity within the sector. For regular investors watching this battle between giants, here is what I would take away. First, do not blindly follow either investor. Buffett's situation is different from yours. He is managing hundreds of billions of dollars and positioning for his successors. Ackman is running a concentrated hedge fund with a specific strategy. Neither of their approaches translates directly to an individual portfolio. Second, be humble about predictions. If Buffett and Ackman, with all their resources and experience, are reaching opposite conclusions, what does that tell you about the certainty of any prediction? The future is genuinely uncertain. Anyone who tells you they know for sure where tech is heading is lying. Third, focus on what you can control. You cannot control whether AI hype continues or fades. You cannot control whether regulators break up big tech. You cannot control whether Buffett or Ackman is right, but you can control your diversification. You can control your exposure. You can control your emotional reactions to volatility. Fourth, consider the asymmetry. If Buffett is right and tech crashes, having some cash on hand means you can buy the dip. If Ackman is right and tech keeps rallying, you will still participate if you hold some tech exposure. You do not need to make an all-or-nothing bet. You can hedge your uncertainty. Fifth, watch the capital spending returns. The key variable to monitor is whether AI investments start generating real revenue and profits. If the hyperscalers can show that their $50 billion annual capex budgets are producing returns, the bull case strengthens dramatically. If the spending continues without commensurate revenue growth, the bear case gains credibility. Follow the money. Let me talk about some specific scenarios for tech in 2026. And what each would mean. In Scenario 1, the AI boom accelerates. New AI applications emerge that generate massive productivity gains. Enterprise adoption exceeds expectations. The hyperscalers show strong returns on AI investment. In this scenario, Ackman looks prescient and Buffett looks overly cautious. Tech stocks rally another 30 to 50%. In Scenario 2, AI disappoints. The technology is impressive, but monetization proves difficult. Enterprise adoption stalls. The hyperscalers face write-downs on their AI investments. Economic growth slows, reducing its budgets. In this scenario, Buffett looks wise and Ackman looks reckless. Tech stocks correct 20 to 40%. In Scenario 3, which I think is most likely, reality falls somewhere in between. AI delivers meaningful benefits, but the path is slower and more uneven than hoped. Some tech companies win big while others struggle. Valuations compress modestly, but there is no crash. Returns are positive but muted, in the single digits rather than the 20s and 30s investors have gotten used to. Neither Buffett nor Ackman looks clearly right or wrong. In Scenario 4, something nobody is expecting happens. A geopolitical crisis, a major cyber attack, a regulatory shock, a technological disruption we cannot anticipate. Black swan events tend to overwhelm careful analysis. Neither Buffett's caution nor Ackman's conviction would have prepared for some exogenous shock. Let me also address what this debate tells us about the nature of investing itself. Here you have two of the greatest investors alive, reaching completely opposite conclusions from the same information. This should be deeply humbling. Markets are not physics. There is no right answer that can be derived from first principles. Every investment decision involves judgment, assumption, and uncertainty. Buffett's framework emphasizes avoiding mistakes, preserving capital, and waiting for obvious opportunities. This framework served him incredibly well over 70 years, but it also caused him to miss some of the greatest investments of all time. the Googles and Amazons that were outside his circle of competence. Ackman's framework emphasizes identifying undervalued assets, taking concentrated positions, and catalyzing change. This framework has generated spectacular returns at times and spectacular losses at others. It requires conviction that you are smarter than the market, a conviction that has both vindicated and humbled him. Neither framework is objectively correct. They are tools for navigating uncertainty. Different tools work better in different situations. The skill is not just in applying your framework, but in knowing when your framework might be leading you astray. For technology specifically, there is an additional layer of complexity. These are businesses that change faster than traditional companies. The competitive dynamics are harder to predict. The terminal values are more uncertain. This inherent unpredictability makes tech investing different from investing in, say, Coca-Cola or See's Candies. Buffett has been explicit about this. He says he stays away from businesses where he cannot reasonably predict what they will look like in 10 years. For most tech companies, that describes the situation perfectly. Who knows what Google will look like in 10 years? How dominant will iPhone be? Will current AI leaders still be leading? These are genuinely hard questions. Ackman would argue that uncertainty is opportunity. If the future were perfectly predictable, there would be no mispricing to exploit. His edge comes from being more willing to make judgments under uncertainty than other investors. Sometimes he is right, like with Netflix before its incredible run. Sometimes he is wrong, like with Valiant. As we head into 2026, here is what I would watch. First, watch Berkshire's cash deployment. If Buffett starts buying aggressively, it means he sees opportunities again. If he keeps accumulating cash, it means he still sees risk everywhere. His actions speak louder than any conference interview second. Watch Ackman's commentary on his tech holdings. He is transparent about his thinking. If he starts expressing doubt, trimming positions, or acknowledging risks he previously dismissed, that is a significant signal. Conversely, if he keeps adding to positions, he is increasingly confident in his thesis. Third, watch the actual results from AI investments. Not the promises, the results. Are enterprises actually paying for AI services? Are the hyperscalers generating returns on their massive capital spending? Is productivity actually increasing in ways that show up in economic data? The gap between AI hype and AI reality will determine who wins this debate. Fourth, watch valuations. If tech keeps rallying without commensurate earnings growth, the risk increases. If earnings growth catches up to valuations, the risk decreases. Simple as that. Fifth, watch the broader market for signs of stress. Buffett's caution might be less about tech specifically and more about overall market risk. If credit spreads widen, if unemployment rises, if leading indicators turn negative, that would vindicate his defensive positioning regardless of what happens to technology specifically. The debate between Buffett and Ackman on tech is not just about technology. It is about how to navigate a market that many believe is expensive, how to think about transformative but uncertain technologies, and how to balance the fear of missing out against the risk of permanent capital loss. Both investors have earned the right to their opinions through decades of success. Both are making thoughtful decisions based on their best judgment, and both could end up being right in different ways. Buffett right about risk, Ackman right about opportunity. For individual investors, the lesson is not to pick a side but to understand both perspectives. Know why Buffett is cautious, know why Ackman is bullish, and then make your own decision based on your own situation, your own time horizon, your own risk tolerance. Because at the end of the day, neither Warren Buffett nor Bill Ackman is managing your money. you are. And the best investment decision for you might not be the same as the best decision for them. Understand the debate. Learn from both sides. And then chart your own course. The battle over tech stocks in 2026 is just beginning. By this time next year, we will have a lot more clarity about who is right. Until then, stay humble, stay diversified, and stay focused on what you can control. That is the only reliable strategy in an unreliable world. Let me go deeper on something that I think gets overlooked in this debate. The nature of technological disruption itself. Buffett has lived through multiple technology cycles and has watched the winners of one era become the losers of the next. Think about the companies that dominated technology in the 1980s. IBM Digital Equipment Corporation, Wang Laboratories. These were the magnificent seven of their era. They seemed unassailable. And yet, every single one of them was either destroyed or dramatically diminished by the next wave of innovation. IBM survived but shrank from a technology colossus to a much smaller enterprise services company. Digital Equipment was acquired by Compaq, which was then acquired by Hewlett-Packard. Wang went bankrupt. The investors who bought these stocks at their peaks suffered catastrophic losses. And these were not speculative startups. These were dominant, profitable, well-managed companies with massive competitive advantages. Advantages that melted away when the personal computer revolution changed the rules of the game. Buffett saw this happen. He saw how quickly technological leadership can shift. And that is part of why he stayed away from tech for so long. It is not that he thought tech was bad. It is that he saw how unpredictable the winners and losers could be. Competitive advantages in technology are real, but they are fragile. One innovation can render an entire business model obsolete. Now fast forward to today. The big tech companies certainly look more durable than the tech giants of the past. They have network effects, data advantages, ecosystem lock. But here is the question Buffett is probably asking. What happens when the next paradigm shift occurs? What happens when some new technology, maybe AI itself, changes the competitive dynamics in ways we cannot anticipate? Consider search. Google has dominated search for over 2 decades. It seems unassailable. But what if AI-powered assistants become the primary way people find information? What if people stop typing queries into Google and instead ask their AI assistant for answers? The economics of that business are completely different. The moat that protects Google search might not protect Google AI. Microsoft faced this exact risk with the transition from PCs to mobile. They dominated the PC era so completely that their products were essentially universal standards. But when smartphones became the primary computing device, Microsoft was nowhere. They missed mobile completely. It took them a decade to recover by pivoting to cloud computing. These examples should give anyone pause about assuming current tech giants will remain dominant. They might. They probably will in the near term. But over a 10 or 20-year horizon, the kind of horizon Buffett thinks about, the uncertainty becomes enormous. Ackman would counter that the current situation is different. The big tech platforms have advantages that previous tech leaders lacked. Their network effects are stronger because the networks are global and comprehensive. Their data advantages are more valuable because AI turns data into intelligence. Their ecosystem lock-in is deeper because they control entire digital lives, not just specific applications. There is merit to this argument. Google, Microsoft, Apple, Amazon, Meta, these companies have proven remarkably resilient. They have successfully navigated multiple technology transitions. They have used their resources to either develop or acquire emerging technologies. They have fought off challenges from well-funded competitors, If any companies can stay on top through the AI revolution, it is probably them. But probably is not certainly. And for Buffett, that uncertainty is what matters. He does not need to be in every winning trade. He needs to avoid catastrophic losses. If there is even a 20% chance that AI disrupts the current leaders in ways we cannot foresee, that risk is enough to justify caution. Let me also talk about the human psychology at play in this debate. Bull markets create consensus. When stocks go up for a long time, everyone becomes a believer. Skeptics get tired of being wrong. Bears capitulate. The narrative becomes self-reinforcing. Of course, tech will keep winning. Look at the returns. Look at the earnings. Look at the innovation. Buffett has seen this psychology before. In the late 1990s, everyone believed the internet would change everything. And they were right about the internet. But they were wrong about valuations. The narrative was correct and the trade still lost money because prices got ahead of reality. Right now, the narrative around AI is extremely bullish. Everyone believes AI will transform the economy. Everyone believes the big tech companies will be the primary beneficiaries. Everyone believes valuations are justified by future growth. This consensus is probably mostly correct. But when everyone believes the same thing, when there are no skeptics left, that is often when the risks are highest. Buffett is constitutionally skeptical of consensus. His best investments have come from betting against the crowd, buying when others were selling when others were buying. His current positioning, massive cash-reduced tech exposure, is a bet against the current consensus. It might be early. It might even be wrong. But it reflects his understanding that the crowd is often wrong at extremes. Ackman is more comfortable going with the crowd when he believes the fundamentals support the consensus view. He is not a contrarian for contrarianism's sake. If the analysis suggests tech is a good investment, he will make the investment regardless of how popular the trade is. His edge is supposed to be in analysis, not in taking the other side of every popular trade. Both approaches have merit. Blind contrarianism is as dangerous as blind trend following. The goal is to think independently, not to reflexively disagree with consensus. Sometimes the crowd is right. Sometimes it is wrong. The skill is in figuring out which situation you are in. Let me discuss one more dimension of this debate. The macro environment. Buffett is not just thinking about individual companies. He is thinking about the overall economic and market environment. And there are reasons for concern. Interest rates remain elevated. The Federal Reserve has signaled that rates will stay higher for longer. This matters for technology stocks in particular, because growth stocks are more sensitive to discount rates. When you value a stock based on earnings far in the future, higher discount rates reduce present value. The AI winners of 2035 are worth less today when rates are 5% than when rates were 1%. The fiscal situation is also concerning. The United States is running massive deficits during an economic expansion. That is unusual and potentially dangerous. At some point, either taxes rise or spending gets cut, or inflation erodes the value of the debt. None of those outcomes are good for stock valuations. Global geopolitical risks are elevated. The war in Ukraine continues. Tensions with China are high. The Middle East is unstable. Any of these situations could escalate in ways that disrupt markets, supply chains, and economic growth. Buffett has always paid attention to the macro picture. He does not time the market based on economic forecasts, but he does position conservatively when he sees multiple risks accumulating. The current environment, with stretched valuations, elevated rates, fiscal concerns, and geopolitical risks, looks like one where caution is warranted. Ackman is more focused on bottoms, Up company analysis. He believes that great companies can thrive regardless of the macro environment. If Alphabet is generating earnings growth and trading at a reasonable multiple, the macro backdrop matters less. Great businesses have navigated recessions, rate cycles, and geopolitical crises before. They will navigate whatever comes next. There is truth to this view as well. Over the long term, stock returns are driven primarily by business fundamentals, not by macro factors. A great company held for decades will likely do well regardless of what happens to interest rates or government deficits. But in the shorter term, the macro can dominate. And Ackman's concentrated approach means he feels macro impacts more acutely when they occur. As I wrap up this analysis, I want to leave you with a framework for thinking about this debate. The question is not whether Buffett or Ackman is right in some absolute sense. The question is what approach makes sense for you given your situation. If you are older, if you have less time to recover from losses, if you have a lower risk tolerance, Buffett's caution is probably more appropriate for you. Preserving capital, waiting for obvious opportunities, maintaining significant cash reserves. These are strategies for people who cannot afford to be wrong. If you are younger, if you have decades to recover from any losses, if you have a higher risk tolerance, Ackman's approach might make more sense. Taking concentrated positions in high-conviction ideas, accepting volatility in exchange for higher expected returns, betting on transformative trends like AI. These are strategies for people who can afford to be wrong occasionally. Most investors should probably be somewhere in between. Hold some tech, but not too much. Maintain some cash, but not excessive amounts. Be aware of the risks that worry Buffett, but do not miss the opportunities that excite Ackman. Balance is usually the right answer, even if it feels less exciting than going all in on one view. The battle between these two investing legends will continue to play out over the coming years. There will be periods when Buffett looks foolish for holding so much cash while tech rallies. There will be periods when Ackman looks reckless as his concentrated positions get hit. Neither will be right all the time. Neither will be wrong all the time. What matters is not picking the winner of this debate. What matters is learning from both perspectives, understanding why smart investors can disagree, and building an approach that works for your own circumstances. That is the real lesson from watching Buffett and Ackman take opposite sides of the tech trade in 2026. The next 12 months will reveal a lot. Watch closely. Learn from both sides. And whatever happens, remember that even the greatest investors in the world sometimes get it wrong. That humility, more than any specific view on tech stocks, is probably the most valuable lesson of all.